Hey everyone, welcome back to another dividend investing video. If this is your first time here, we're all about dividend growth investing, building up our passive income with some basic simple principles of consistency. And if you're a returning viewer, welcome back. I'm glad to be back and thank you for your patience as I have been away for a couple weeks. Took a little bit of time away from things. I went to Europe and kind of unplugged, but I'm back and I have lots of great content coming. In today's video, we are going to talk about 3 stocks that I think are compelling buys for fall of 2023. Summer is ending, fall has begun, and lots of great stocks are on sale. And these 3 in particular, I think, are among the most interesting, compelling out there. And I'm going to give you my rationale on all 3 of these, and I happen to own 2 of them myself. So let's get right into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. And folks, only 34% of you guys watching this are actually subscribers, so hey, make sure you're subscribed. I have a lot more great video content coming. Help me in my push to hit 20,000 subs. That would be mind-blowing. All right, let's go over the 3 stocks that I like right now. At the end, I'm going to quickly cover a few more stocks I think look good right now, because I think a lot of stocks have gone on sale over the last few weeks, so to speak, over the last month. All right, so the first stock I'm highlighting today is United Parcel Service, ticker UPS. UPS, this is part of the industrial sector, specifically in air freight and logistics. They deliver packages both domestically in the US and internationally. They are in the business of shipping, receiving, and supply chain management. They have over 400,000 employees, have been in business since 1907, and are headquartered in beautiful Atlanta, Georgia. They are the largest courier in the company in the world by revenue. Year to date, those shares are down about 10%. More recently, in the last month, shares have slid over 7%, so I think that's put this company into a compelling spot. UPS is trading at a forward PE of 16.7, just a touch higher than its 5-year average. Pretty close to being in line with that. Also a bit below the industrial sector mean of 18.2, and shares of UPS today are yielding over 4%. That's 4.11% at the time of publishing. That's 24% above its 5-year average. And this has become an opportunity with UPS we've not seen since before the COVID crash in 2020 occurred, which you can see on this chart. So this is a chance to lock in an over 4% yield with UPS right now. So the dividend is paid out quarterly in the months of March, June, September, and December at $1.62 per share for total annual payout of $6.49. The dividend makes up 69% of forward earnings, 92% of forward free cash flow. So free cash flow is down this year, but I think it is a blip due to rising costs, especially energy costs. These are greatly going to affect a company like UPS, which deals with transport, so keep that in mind. Now, I think it's a short-term problem, and that long-term, patient investors can take advantage of this and potentially make some cash. Simply Safe Dividends provides a safety score of 69 for UPS, which is safe with the belief that a dividend cut is unlikely. We're looking at a 13-year track record of dividend growth, an uninterrupted streak of 24 years without a reduction. So the dividend was maintained during the recession of 2008, but at least it was not cut, which I think bodes well for the current headwinds the company is facing. And the 5-year average dividend growth rate is 13%, pretty solid. The latest was a bit lower at 6.6%, so perhaps more reasonable is to expect growth in that high to mid-single digits going forward. And I think the next raise or 2 could be a little smaller just because that free cash flow situation is under pressure. But again, I think this is a short-term outlier, not a long-term downward trend, not financial advice. The UPS does offer other things we like to see. UPS does other things we like to see. They do have a declining outstanding share count over the last decade, going from 948 million shares outstanding in 2013, and currently there are 869 million shares outstanding. And a solid track record of above average return on invested capital, currently at 24%. And this is actually on the low side for them, but still it's looking great. Wall Street analysts give UPS an average price target of $186.39. This represents a little more than 18% upside. Couple that with a 4% dividend, and there could be some money to be made with UPS. Not to say it's without risks. You could just go buy SCHD, which happens to maintain a nice position in UPS as well. But right now, UPS is about as compelling of a time to buy as I've seen in the last 5 years. But I do think it could continue to drop. I'm not good at short-term trying to time things, but I do feel confident in holding a company like this for the next 10 years and beyond. And I do have a small position in one of my accounts, and I'll likely add another share or 2 here this fall. All right, stock number 2 is Texas Instruments, ticker TXN. Founded in 1930, headquartered in Dallas, Texas, Texas Instruments designs, manufactures, and sells semiconductors to electronics designers and manufacturers, both in the US and internationally. This is one of those companies that is likely in your everyday life, you just don't realize it. They operate in 2 segments, analog and embedded processing. Well, best known for their calculators, probably you might have used in high school or college. That's really a tiny portion of their business. This is a company that models just about everything you want to see in a dividend growth stock. So Texas Instruments shares are down about 9% over the last 6 months, creating what I think to be a wonderful opportunity in a quality company. This is a company that's up over 400% over the last decade, more than doubling the total return from an S&P 500 index. And Cat's going a little crazy, pardon that. Part of why I think Texas Instruments is down so much lately is they have a rather significant drop in free cash flow per share this year. And that's, notice on the graph, very consistent free cash flow growth, but rising costs have hurt this company. So like UPS, it's a question, is this a blip or is this something that's fundamentally changed? Now shares are at a forward PE of 21.6 at the time of publishing. It's a slight discount, about 6% from its 5-year average below. Now shares are also yielding 3.24% currently. So from a dividend yield theory perspective, this makes TXN potentially undervalued as it's 17% above the 5-year average dividend yield of 2.77%. This is a dividend that pays out quarterly in the months of February, May, August, and November in the amount of $1.30 per share for a total annual payout of $5.20 per share. The payout ratio is starting to get a little high for Texas Instruments. Currently, it's at 70% of forward earnings. Like I said, I think this is an outlier. When you check out the consistency of this company over the last decade, really the last 20 years, and Simply Safe Dividends provides us a dividend safety score of 90 for Texas Instruments, rating this dividend as very safe, making a dividend cut highly unlikely. Now, Texas Instruments, they've gone 61 years without a dividend reduction. It's very impressive. And they're growing this dividend at a nice rate of 11% on average annually over the last 5 years. But dividend growth is starting to slow down. But again, we're in a time where their free cash flow is under some pressure. They announced their latest dividend raise just the other day, their 20th consecutive annual dividend raise. It's at 5%, so that's still respectable, especially in this current environment where a lot of companies are announcing lower dividend raises than average. There's so much to like with Texas Instruments. They have low debt with a net debt to EBITDA of only 18% and a net debt to capital of a mere 9%. Management is extremely conservative when it comes to this sort of thing. And Texas Instruments, they've been buying back shares every year, going from 1.1 billion shares outstanding in 2013 to 918 million at the present day. So I'd love to see that. And the average analyst price target for TXN is $184.75. This represents about 14% upside from where shares are today. I think Texas Instruments is one of the most well-run companies out of the stocks in my own portfolio. They have an excellent track record of as a dividend growth stock. I call them a compounder, really. I like adding to this position when their dividend yield is above 3%. That's what I own. That's what I personally do. I have it in a few accounts, including my Roth IRA. I was adding a lot to that last year. It's finally come back down to those buying levels for me. All right, the third stock on my list today I think is at a discount is none other than Nike, ticker NKE. Nike is the largest apparel company in the world. They've dropped big in 2023. What is going on with Nike? Like all these companies, they're facing elevated inventory levels, facing increasing pressure with inflation, and growth has slowed down in China. But if any clothing company can sustain such headwinds, it's Nike with their branding power, their leadership in global apparel. The stock is down 23.5% year to date, absolutely clobbered, looking something like a REIT. But Nike has returned nearly 200% of total return in the last 10 years. And up until a couple months ago when it started really falling, it was beating the S&P 500 during the entirety of that last decade. So I see that and think this could be a unique opportunity to own what's a classic brand, one of the most recognized globally, really. Shares of Nike are trading at a forward PE of 24.7. And at first glance, this might seem high, right? But you have to remember that Nike trades at a premium, has always traded at a premium. And today that valuation in terms of PE is 22% below a 5-year average of 31.9. So this could be a fantastic opportunity. Nike looks even more undervalued in terms of dividend yield theory. Shares are yielding about 1.5% today. And this is 50% higher than the 5-year average yield of about 1%. So while it's a lower yielding stock, I don't often get the chance to lock in this high of a starting yield. So again, this is looking like an opportunity to me. The dividend is paid out quarterly on a somewhat irregular schedule of April, July, October, and December, paying out 34 cents per share for a total annual payout of $1.36. Current investors could look forward to that next dividend on October 2nd. In terms of dividend coverage, taking up 34% of forward earnings and 40% of forward free cash flow, looking solid. Safely Safe Dividends gives Nike the highest possible safety score rating at 99, very safe. A dividend cut is extremely unlikely for Nike. And yes, if you're going to buy a dividend growth stock at less than 2% yield, you definitely want to see well above average dividend growth. Nike has been delivering on that front. We have 39 years of uninterrupted dividends and 21 years of dividend hikes every single year. Over the last 5 years, that dividend has been growing at an average rate of 11% per year, so that's pretty darn consistent, double-digit dividend growth. The last raise last year was also at 11%. We should get news of that December dividend at some point in November. Now, Nike is another company that has next to no debt, very little debt, the net debt to EBITDA of 0.17, and net debt to capital of 10%. And shares outstanding are on a slow but steady decline, revenues with a nice steady incline year over year. Really everything we like to see in a company we're seeing here with Nike, other than the massive drop in share price. But this could be a gift for shareholders. Look, the average analyst price target, $126.12. That's a massive 39% upside from where shares are today. So the average analyst sees the stock significantly higher than it is today. So it looks like there's some potential money to be made in a great brand. These lower dividend, higher growth stocks, I get that they're not all for all the investors in my audience. But if you have time on your side, say you have 10, 20 years more, I think your portfolio is probably going to be better served to have a lot of companies like this that don't necessarily pay as high of a dividend, but they generally appreciate in share price, and the dividend is growing at double-digit rates. So other companies in this category to me are like, United Health and MasterCard, Visa, Costco. Of course, if you're relying on dividends to pay your bills, you're looking for income today, you're probably not that interested in Nike. So that's just something to consider. All right. But let's briefly cover a handful more that I think deserve a spot on your watch list and also look compelling right now. One of the most obvious right now is Realty Income, ticker O. So most REITs are getting hammered right now, and the monthly dividend company has been no exception. Down nearly 20% year to date, but the monthly dividend looks no less safe to me. This recent drop has pushed O's yield up to near 6%. And if you think that Realty Income comes out of this current situation on the other side, this looks like an excellent opportunity to get that steady growing monthly dividend at an exceptionally high rate. It's 37% above the 5-year average. Now, I didn't include O in the main group today because my next video is about these retail REITs where I'm going to go into more detail, okay? Also, don't look now, but Vici Properties has crossed below that $30 mark. It probably hit a lot of folks' target buy price. This one has not been hammered as hard as most of the other REIT sector. It's only down about 6% year to date, but sitting close to that 52-week low. Earlier this month, Vici Properties announced a dividend hike of 6.4%, making the young company to 5 years of dividend growth. Shares today are available at around a 5.5% yield, so this is your chance to own some of the most luxurious resort properties along the Vegas Strip. And a lot of investors are excited for the future here on this one. I've been buying this in both my YouTube portfolio here, as well as my Roth IRA. That's Vici Properties. Okay, I also wanted to highlight Kroger, ticker KR, the largest supermarket operator by revenue in the US. You guys who follow me know this is one of my favorite dividend growth stocks. If you can get past the thin margins these grocery stores run on, they do everything else. Just what I like to see when I'm looking at a company for dividend growth stocks. Dividend yield is about 2.5%, which beats the broader market, and the latest dividend raise back in June was a 12% dividend hike. This company has been consistently putting out double-digit dividend raises. Shares are up about 2% this year. I add to my own positions as long as it's below like $47-ish. So it's right there for me, and I'll be adding more to this one this Wednesday. That's the plan. I'm a very happy Kroger shareholder, and I think they've come back to a level where it deserves a mention, at least adding to your watch list. I wouldn't buy it for the Kroger-Albertsons merger. That's still very much up in the air, so could be something changing with that. But if that goes through, they're going to be even more massive. Okay, and I also think we have a decent risk-reward situation with the pharmaceutical giant Pfizer, ticker PFE. This company is down massive, more than 35% year to date. I think a lot of the hype around the vaccines died down, or maybe they just got so hyped up, right? And now they're coming back to earth, but look, they've made several acquisitions to expand their drug pipeline as well. Now, despite the drop, this dividend still looks reasonably safe. We have reasonable payout ratios, low debt, but do keep in mind, this was a dividend cutter in the last recession, but we have 12 years of dividend growth since then, slow but steady. Shares are available at a 5% yield. It's about 35% above the 5-year average yield of 3.76. So if you're looking for current income, locking in a starting yield of Pfizer above 5% looks pretty good to me. And as always, I want to stress that stock picking is not your thing. It's perfectly acceptable to solely invest in index funds and ETFs such as SCHD and VOO or VTI. This is a great way to protect yourself from individual companies just going apeshit and losing a bunch of money. I think that's important to keep in mind. All right, guys. As I am back now, expect a lot more exciting content to come. I have a video coming on some retail REITs next, which have been particularly hammered. And then one on some of the underrated ETFs I think deserve some more attention. Then I'm really excited about the next one. It'll be a video marking the 1-year anniversary of my YouTube channel's public portfolio. Super pumped to share the progress there. We have 1 year ago, so it's brand new. And look, in the month of September alone, it's already brought in more than $50 in dividends this month. So look, in that short year, you can make real progress. You just got to be consistent. Thank you for sticking around. You could help me out massively by liking this video and subscribing, because YouTube's likely going to be punishing me for going on vacation. So help a brother out. And until next time, my friends, keep investing.